If someone walks up to you on the street and hands you a wad of cash, you don't call a committee meeting to discuss this. You put it in your pocket, buy a bottle of something expensive, and call it a great Tuesday. But this is accounting, specifically IAS 20, where joy goes to die. You would think that a government grant is the one time a company gets to smile. It should be simple. Debit cash, credit, party time? No. The sadists at the IASB looked at free money and decided, you know what? This looks too much like happiness. Let's make them suffer for it. They turned a gift into a logic puzzle where you have to prove you were worthy of the money you already have in your bank account. If you think it's ridiculous that you have to jump through hoops just to admit you are richer than you were yesterday, you are entirely correct. Think of a government grant like a birthday check from your extremely judgmental, controlling grandmother. She hands you an envelope with $5,000, but before you can run to the dealership to put a down payment on a jet ski, she grabs your wrist with a grip like a steel trap. "This is for college tuition," she hisses, "and you only get to keep it if you maintain a 3.5 GPA and visit me every Sunday." Now, you have the cash in your hand, but can you go around telling your friends you are rich? No, because if you fail that calculus exam or skip Sunday brunch, Grandma is taking that money back. If you spend that money on a jet ski today and then flunk out of school tomorrow, you are financially ruined. You are essentially holding that money hostage. It's not yours yet. It's just resting in your pocket while you dance to her tune. The government is Grandma. And IAS 20 is the rule book that stops you from buying the jet ski before you pass the class. Okay, put the jet ski away. The core philosophy here is the matching concept. You cannot recognize the income until you incur the cost that the grant is intended to compensate. Recognition. You cannot just book the grant because the check cleared. IAS 20 says you can only recognize the grant if there is reasonable assurance that you will comply with the conditions attached and the grant will actually be received. If you have the cash but have not met the conditions, that is not revenue. That is a liability. You owe the government performance. Measurement. This depends on what Grandma gave you the money for. If the government gives you money to pay wages, like during COVID, you recognize the grant as income in the same periods you pay the wages. You match the free money against the expense. If the government gives you $1 million to build a factory, you don't book $1 million of profit today. You have not built anything. You have to spread that benefit over the useful life of the factory. Sometimes the government gives you land or a license instead of cash. IAS 20 usually requires you to record this at fair value, then recognize the income as you meet the conditions. Here is the bottom line, and pay attention because this stops you from going to jail for fraud. A government grant is not a gift. It is a contract. If you book the full amount as profit on day one, you are effectively lying to your shareholders about your sustainable earnings. Treat government grants like a loan that you might not have to pay back if you behave yourself. Until you have spent the money on exactly what they told you to spend it on, keep it out of your revenue line.